Hey, it's Al from Boston. Another video on financial statements. Three kinds of financial statements I want you to be aware of: income statement, cash flow statement, and the balance sheet. Right? Those are very important. These three are the meat and potatoes of a company. This is where you find out how the company's doing, see how much debt they have, how much money's coming in, what their liabilities are, all that stuff. I'll make this quick because it's kind of boring and it's kind of dry, and I'll make it as interesting as possible. Let's kick it. All right, the income statement. Let's take a look at this, right? This is Microsoft. This is a made up one, I think. I don't think it's even real. It might be real, who knows? But this is the 2011 income statement. Normally income statements tend to be quarterly or yearly, depending on how where you go to get your information from and how it's structured. The income statement is a report that's a company generated, that is generated by a company in order to communicate how much money it's earned over a period of time, right? A quarter, if you will, or an annual report. In addition to communicating a top line revenue, income statements detail the number of other metrics that can be helpful to an analyst and investor, right? Those are incredibly important things. So if you pick out XYZ company that you want to invest in, and the first thing you want to look at is the operating expense. How much does a company take? How much money does a company take to make and operate a pharmaceutical company? Look at what we have here: the cost of revenue, how much it costs to make money, the revenue, the research and development costs, their sales and marketing, the general administration costs. These are operating expenses, right? And it adds on. And then there's the depreciation, which quantities that extend to which a company's assets. For example, aging equipment of vehicles. Let's say you bought a $100,000 electron microscope and it depreciates quickly, right? You want to make sure that that's on this list, and that you earned or you lost and you gained, because there's also appreciation. Don't forget that. You want to make sure that's on these lists, and you understand how much money they're spending on it and how quickly they're depreciating or appreciating, depending on what you have. Net income subtracts the company's expenses from its gross revenue in order to determine its total level of profits or losses. In other words, all the expenses taken out, what you have in the bottom line, right? And of course, earnings per share, EPS. This divides net income by the total number of outstanding shares. It's basically, how do I explain this? It's the shares. It's the shareholders' equity is something this is connected to, right? How much can the company make per share, right? If it's just a basic one, if it's diluted, there's other factors involved in, like the WACC, and there's a bunch of stuff in there. You don't need to know about it. All you need to know about is being able to see the following: the operating costs, how much it costs to run the operation. This comes later on. A more mature company, I wouldn't even bother looking at it. In fact, half the time I don't even look at it because I don't know what the hell they're talking about. These statements tend to be really convoluted at times. There's no, if you're just getting in and you're not a finance person, it's a total pain in the neck. I don't even bother looking at that stuff. I don't even want to. I just want to see how much they're using to run the company and what they're spending and so things of that nature, right? So let's go to the next one, which is the cash flow statement. All right, in the cash flow statement, there's three sections: there's the operating activities, the investing activities, and the financing activities, right? The purpose of a cash flow statement is to provide a detailed picture of what's happened to a business's cash during a specific period, known as the accounting period. In other words, what are you spending your money on? It demonstrates the organization's ability to operate in the short and the long term based on how the cash is flowing in and out of the business. So depending on how much you have, this is what you spend it on. Something to that effect, right? Easy. And like I said, three basic functions: operating, investing, and financing. Operating activities detail cash flows that generate once the company delivers its regular goods and services, including both revenue and expenses. This is what's left. This is the money that's generated from that, okay? Investing activities, including cash flows from purchasing or selling assets. Think physical properties such as real estate, vehicles, non-physical properties like patents and using free cash and not debt. In other words, you have money to spend on these things, to invest in the company itself, marketable securities, sales of stocks, you name it. And of course, financing activities, detailed cash flow from both debt and equity financing. Once again, these are the primary things they're doing with their money during a given period of time. So each quarter they have this document, and it basically tells you the money coming in, what they're spending it on, and how it's being used, basically, right? The financing section, purchasing of common stock, buying back, selling, all that stuff. It's all in there. It all has to equal out, right? That's the other thing. The balance sheet, okay? This is the one that has to equal out on both ends. Total assets and total liabilities. You notice there's a correlation to the same price. A balance sheet is designed to help you communicate the book value of a company. It's a simple accounting for all the company's assets, liabilities, and shareholders' equities, and offers an analyst a quick snapshot of how a company is performing and expects to perform, right? So most balance sheets follow the basic formula. Your assets is your liabilities plus your shareholders' equity, okay? An asset is anything the company owns which you have quantifiable value in. In other words, property, vehicles, real estate, machinery, unsold inventory. If you're McDonald's, you might have billions of dollars in unsold inventory, like burgers frozen in a warehouse somewhere. That's an asset, believe it or not, as well as non-physical properties, patents, trademarks. We talked about IP in the past. That's what it means, okay? Liabilities refer to the money that a company owes to a debtor. That includes outstanding payroll expenses, debt, rent, utilities, insurance, money owed to suppliers, taxes, bonds, so on and so forth, right? Okay, shareholders' equity. Let's talk about this real quick. It's a term that generally refers to the net worth of a company. It reflects the amount of money that would be left if all the assets were sold off and liabilities were paid off. The money belongs to the shareholders, whether they are private owners or public investors. The statement of shareholders' equity is a financial statement that details changes in the equity held by the shareholders, whether those shareholders be public or private. The shareholders' equity will typically report changes in the number of shares and values of common and preferred stock, as well as details about whether or not the company has purchased back any stocks previously held by shareholders, called treasury stock, and other data points. So very simple stuff, very quick. You just need to know the following from these things, right? Stockholders' equity, important. Assets, liabilities, all important things. Just take a look at these numbers. If they're grossly high, you know, and for that industry, or they're just pissing through money, I hate to use that word, they're just pissing through money, be careful about that. Just be really cautious. The cash flow, if they have tons of cash coming in, then you can justify this part because they have tons of money coming in, right? If they're bringing in revenue, perfect. And in that period of time, they're spending it to better the company and they're growing, you know, and you can see that from month to month, quarter to quarter, the changes that have been made. Absolutely. Go absolutely invest in that company, right? And then you get the income statement, your revenue, your operating expenses, your basic earnings per share, your operating expenses, your net income. There's a bunch of other stuff on here that's actually just kind of consolidated right now, but as you read more, you'll see it. But here's what you do with these things. This is where I would start. Before I start picking companies, I'd learn to master the income statement, the cash flow, and the balance sheets. Get a good understanding. There's tons of YouTube videos on it. I would master those before you start picking companies. That way you have a fundamental understanding of how the business is operating, right? If it's cash flow positive, if it's being run into the dirt, if they're just pissing through money, whatever, how much shares they have diluted shares, they have common stock, preferred stock, equity bonds, whatever, corporate bonds rather. Those are things you want to understand. And this is the three forms that you learn in the beginning. Start with these, master these, and then we'll start talking about companies and whatnot. So this is Al Matthews, and I see that Sam is calling me, Astro. And I will call you guys. I'll talk to you actually in the next video. Thanks again. Take care. Bye.